Welcome back to Morning Markets, and thanks a lot for being here with us. As we continue to talk about what the latest Bank of Canada rate cut could mean for the housing market across the country, one area that many may be overlooking is the rental housing market. Let's talk about that with a key player. Adrian Rocca is Chief Executive Officer of Fitzrovia, a developer of rental housing. Thanks a lot for joining us.
Thanks for having me.
Before we get into the Bank of Canada and the market, tell us a bit about Fitzrovia and what it does and where it does it.
Yeah, so we are Canada's largest purpose-built rental developer. We're fully vertically integrated. We develop, construct, asset and property manage entirely in-house. We have $10 billion of assets under management. We're principally headquartered in Toronto, but also have an office in Montreal. And then we invest across the spectrum. We develop, and then we hold long-term. We're not a merchant builder. That's what we call Class A rental. We also have a value-add program that buys vintage properties and repositions those over time. We have a Core Plus bucket, and then we also have a student housing strategy as well.
And it's all rental housing, correct? No, there are no condominiums here, correct?
We don't do any for-sale housing. It's all rental.
And how would you describe your unit? You didn't like the phrase high-end off camera when I pitched that at you. How would you describe your position in the rental market?
Yeah, we would say it's Class A, new rental product. It very much looks like a boutique hotel. That's how we would describe it.
Okay. Interest rates are coming down. Mortgage holders around the country are hoping that they come down further. What is your take on lower rates and your segment of the housing market?
Yeah, so I would say I lived in Europe, in the UK for 7 years. So I would say it's a keep calm and carry on headline. It was in line with market expectations. There's basically no movement. Actually, you're seeing the 10-year bond rate tick upwards by about 9-10 basis points around that announcement. So that there's actually no impact on valuation yet. It's definitely a step in the right direction. We typically, on the construction side, would model the forward curve when we are looking at financing rates. So that was lockstep with expectations as well. So it was really a neutral announcement. We'd love to see more rate cuts. We'd like to see a positive surprise to the market. At least it wasn't a negative surprise.
The big issue with housing is supply. Talk to us about what your thoughts are on what policymakers can do to drive more supply in your segment of the market, the rental market.
Yeah, so we've been actively discussing with all three levels of government to get two specific government incentives in place to get more supply into the market. If you look at over the last 3 years, we had construction costs escalate by about 41%. Interest rates, everyone knows the well-publicized headline is what's happened there. And we've seen kind of rental rates kind of flatline with the significant amount of condo inventory that's been delivered on the market. The reality is, the last 2.5 years, very few product has been built. You're basically down, depending on whose data you're looking at, between 70 and 90% on new starts over that period of time. And so we got to get more supply into the market. The main lever to get supply into the market is government-led. So our charges, municipal fees are very, very high right now. And so we are asking for a full development charge waiver for a period of 2 years. If you start a new project within that period, you'll get a full DC waiver. We're also
what exactly does that mean? It means what it sounds like it means, I guess, a complete waiver of fees. You don't pay those fees.
That's right.
As a way to get activity going in the shorter term.
That's exactly it. We want to change the economic profile of our deals as an industry group. The other one is so we're also asking for a DC waiver, a parkland waiver, and a community benefit charge waiver over that period of time. In addition to that, we're also asking for a 20-year property tax abatement. So that was a very effective strategy that worked, especially in the Sun Belt in the U.S. when they want to encourage, quick new amount of supply. For every dollar that's saved in terms of net operating income, it's a $30 impact on valuation. It's a very effective tool to get more supply into the market.
A 20-year property tax abatement. Explain what that means.
So that would be no property tax for any new purpose-built rental that is built in the next 2 years for a period of 20 years.
And that tax would, in ordinary circumstances, would be payable by who? Not the person who's renting the apartment, obviously. No, the owner of the building.
That's a landlord cost. That's right.
Do you think governments are going to swallow that, a 20-year abatement on property taxes?
We hope. That is, again, the most cost-effective tool. If I look at development charge waivers, for every dollar that's forgiven by the government is $1 gained, whereas for every dollar on an annual basis that's forgiven is a $30 impact to the private sector. sector or the public sector as well.
And you say this has worked, has a successful track record in the United States.
That's right, specifically in the Sun Belt.
Right. Are you making these? Who are you making these requests of? Which governments?
All three levels of government. We think it needs to be a coordinated effort across the board.
That would be the federal government and the provincial governments of Quebec and Ontario and the municipal governments of Toronto and Montreal?
Yeah, so we're not currently developing in Montreal, so it's really the province of Ontario, the federal government, and the city of Toronto.
What are your thoughts on getting more affordable housing built? That doesn't seem to be your niche, but you would know a lot about it, I'm sure.
No, we were absolutely focused on affordable. So we are right now looking to launch what's called the Fitzrovia Social Impact Fund.
Okay.
So that is really primarily connected to what's called ACLP, which is a new CMHC debt program. It's got lots of acronyms in the market. It used to be the old RCFI debt program. So the problem with that program, it's very cost effective. We could get 90% leverage. It's based on the 10-year GOC rate, so very cost effective, and you lock it in for 10 years, and you have to do a minimum of 20% affordable units. So if we could get access to that program, it really unlocks new supply. The issue is we're at capacity. And so we need the government, we need CMHC to increase significantly the size of that program.